Good morning, everyone. Today it is Monday, January 11th, and we here at Harvested Financial are looking at the markets. But before I totally get into that, I just need to jump into some brief disclosures, and that is that all of the information, commentary, and opinions expressed on this or other websites or in any social media platforms or in any media format reflects the personal opinions, viewpoints, and interpretations of the employees providing such comments and are not to be considered a description of financial advice or advisory services by Harvested Financial. The opinions expressed are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual on any specific security or investment product. It is only intended to provide education about the financial industry, and in no way is the content on this website meant to convey investment advice, performance data, or any specific recommendation to buy or sell securities. Harvested Financial employs multiple methods of analysis and security selection to create client portfolios, which are not discussed in their entirety here. All investments carry the risk of loss, and users should discuss any decisions with their financial advisor. Past performance is not a guarantee of future results. So what are we looking at today? Well, markets are down a little bit. We have the SPY down $3.40, which is 90 basis points, almost a whole percent. We have IWM off $2.50. That's 120 basis points, a little over 1%. And the Qs are down 420, down 1.35%. So we're seeing technology names really fall off here. Apple's down 2.5%. Tesla's down almost 5%. So a little bit of a red Monday here that we have here. But you know what? All that means is that there are more sellers than buyers today. We try not to read too much into any given day in the markets and take the ups with the downs because we believe in systematic advice and systematic execution of option strategies to generate income over time. Provide exposure, generate income, all the kinds of things you want to do out of an option strategy. You can't get too obsessed with the tick by tick of the markets. So what are we going to look at today? Well, this week I want to focus on another really core option strategy. Last week we talked a lot about zero cost collars and how in a way they're the only thing out there in the investment landscape that will give you something for nothing. So this week I want to talk about a little different version of that. And that's actually if we take off the put leg of the zero cost collar, and that would be the most common option strategy, options 101, covered calls. Now it sounds really basic, but these things can be so powerful for generating income, particularly in highly volatile names. They let you convert the implied volatility and the high premium that people are willing to pay into cash money for you today. So that forgoes upside. And in a lot of these volatile names, a lot of the upside is part of the interest. So you want to make sure that this type of strategy fits exactly what you're looking for, but the potential for premium generation is quite significant. So to kind of give some good examples here, I'm going to share my TradeHawk and take a look at what's going on here. So Tesla's a great name to pick just because not only is it very high dollar, but it's also a high implied volatility name. So not quite as crazy as it's been in the past, but trading right now around an 89 ball if I look to January. If you go all the way to the Feb serial expiration, at Feb 19th expiration, trading around an 88 ball. So that is going to generate some pretty fat premiums for us. But if we want to think about this kind of on a weekly basis, so we're coming in on Monday, we're looking just to think about Tesla over the next couple of days. How should we think about that, and what kind of premium can we generate from a covered call strategy? Well, with stock trading around 840 almost, I'm going to look at the 840 call and think about this from an at the money perspective. So the 840 call is around 50 delta right now. So just to show you where I'm looking, interestingly, that's a 52 delta because of the forward value of the stock. So in some ways, like just the high forward value and volatility is pushing that delta slightly above 50, even though it's technically dollar at the money. But what we're looking at is this market being around 33.5. So pretty interesting tight markets, actually, only 90 cents wide, 33.45 at 32.45. They're flipping around a little bit, but meaning we can sell this 840 call for around $32, maybe a little more if we get the right execution quality. Super important. We focus on it big time. But collecting about 32 bucks on that means over the course of this week, if you buy right, meaning you buy 100 shares and sell one option against that, you are going to own 100 shares of stock, $84,000, and you're going to collect $3,200 in terms of premium. So pull out my trusty calculator. In 1 week, 3,200 divided by 84,000, you're going to earn 3.8% in just 1 week. So that means you have 3.8% of buffer on the upside, meaning you're not necessarily going to lose any more money, but you would have made more if you had continued to own that stock. So that's really important to consider here, is that FOMO, fear of missing out, is going to be one of the bigger risks in doing a covered call trade. To the extent that you buy 100 shares of Tesla and it rallies up to 900 by the end of the week, well, you're going to feel a little bit of FOMO. You would have done better. You would have made, $60 a share instead of, the $30 a share that you're going to make with this covered call strategy. So if you really think Tesla's going to run, you probably don't necessarily want to sell covered calls against it. However, if you want a little bit of protection against the downside, that 33, 32, 34 bucks now that you're going to collect by selling those calls, that does give you a little bit of neutralization on the downside. So to the extent that Tesla goes down to 805, you're essentially neutral as far as what you would have happened if you had just bought the stock anyway. So it does give you a little bit of downside protection to the extent that that cash offsets the loss that you're making in the stock. To the extent that Tesla continues to go down, below that 805 level right now, well, it's going to be the same as if you had just owned that stock anyway. So when you're thinking about covered calls, you do want to find names that you would have been relatively bullish on anyway. And if you're relatively bullish and they have high implied volatility, well, you can really capture that, earning that 3.8% per week. And so that's even for a partial week here, right? We're only looking at 4 days of exposure. We didn't even give you the weekend's worth of exposure. So 3.8%. And if you think it's going to be bullish, you're still going to capture that 3.8%. You're still going to earn that $3,200 every week for every contract you write in Tesla, but you just wouldn't have earned as much as if it went up. So a lot of things to think about, but names like Tesla that are high vol, high conviction, make a really interesting play for a buy writer, because you can capture a lot of income, still remain bullish, but really convert that into cash and think about your assets more as a yield generating return. So this isn't free money. It's not like you're just pulling it out of somewhere. It does take risk, but it doesn't take any more risk than owning the stock in general. And it provides an opportunity to generate some additional income from your holdings. So lots of really interesting things to talk about with covered calls. We're starting out with something really basic, at the money, writing this 840 level call in Tesla for the end of the week. But stick around. We're here every morning at 8:35 Central, 9:35 Eastern, talking about the markets. This week, we're going to be focused on covered calls. There's so many different dimensions you can do. Harvested Financial is the first options robo-advisor that is bringing these types of strategies to individual investment accounts. So you can set up a covered call strategy where you're selling the at the monies in Tesla. You can set something up where you're selling the 10% out of the monies. You can think about it in Delta space. You can think about it in Tesla, Apple, Microsoft, SPY. All kinds of really fun things you can do with covered calls. They're not just the boring options 101. They are a key portfolio strategy, and we are all about them at Harvested Financial. So like I said, check us out every morning, 8:35 Central right here. We're also on Twitter at harvested_DAFE, because derivatives are for everyone. So make sure you hit that subscribe button, tune into the Daily Bread. We appreciate everyone here. Thanks for stopping by, and we will see you again tomorrow.